Am I live? You can hear me? Great. Thanks for being here. I was having breakfast with my daughter at 7 a.m. and it was pitch black outside and pouring. And she said, I said, my God, like, there's nothing that could make this presentation bad. It's so good, except for like a squall warning on my iPhone. She said, don't worry, Daddy. You're so good, it's going to be bright in there. So good advice. So my name is John Bloomberg. I am going to introduce Jordan. A little background on me. I, together with my father, Lawrence, somewhere, and another business partner, Sanjay, have built a firm called BloombergSen for the last 17 years. And it's a pretty value-oriented, like Buffett-style investment firm. We manage a couple $2 billion on behalf of a few hundred families. And in the 17 years, we've met so many young people who want jobs, and I interviewed lots of investment people. And we haven't hired anybody, and we certainly haven't staked and backed financially and with our reputation anybody to build a new business. And that has only happened once, and it's with Jordan. So the reason that happened was we had an investment together a number of years ago, and I met him. He was at a different firm. And he wanted to be an entrepreneur, and we started talking about stocks and investing, and there was something like very different pretty quick in that conversation. And as I do with some people who I start to get interested in, but usually never ends with anything, is Jordan and I went for a walk near my house, and we started talking about investing in stocks. And he was able to, he has a very different style than what we do, and was able to convert a growth style of investing into a language, and he could sort of confidently talk about a company in a way that would make me want to buy it, in a type of company I would typically never look to buy. And that is pretty rare for me. So we talked about DoorDash, which you probably all know that brand and name, years ago, and it looked like a bit of a dog's breakfast on the surface, losing money. And by the end of our conversation, I thought, I should study this company as well. And from that led a whole bunch of conversations and ultimately a partnership to where we are now, almost 4 years later. And over those 4 years, which you'll see in a minute, is like time and time again, that same sort of conversation has happened. So as recently as 6 months ago, Jordan came into my office and said, hey, do you know this company called ThreadUp, whose CEO is here? And I said, no, I never heard of it. And I pulled it up, and again, it had this sort of like image of something I would not naturally study. It was losing a bunch of money on the surface. And he said, no, you're sort of missing it. There's something happening underneath the surface here that's changing. There's like an inflection in this business that's going to make it really profitable. And over time, those profits are going to show, and it's going to create a lot of value. And he said, by the way, I remember this part. He was like, I don't think anyone else knows this. I'm the only guy who seems to have figured this out or care. And it's sort of appeared that way. Stock was sort of left for dead, and it's been well north of a 10-bagger since we had that conversation, which is pretty unusual. So 2 more comments, and I'll pass the mic. Just logistically, there's a bunch of cue cards on your table. You can use them if you have questions, and we'll come by and grab them from you when we stop for Q&A, which will happen twice. And the other thing I wanted to mention just before I stop is there's another partner in Optimist named Brandon Snow who's here, and you'll see him at the end in the Q&A. I won't go through his whole bio, but I think hopefully you'll hear it later. But he's also like an incredibly accomplished investor, and it's like a real coup for us to have him on this team. So maybe with that, Jordan, come up on stage, and I'll pass the mic. This is really good. You'll enjoy it. Thank you.
I'll put this here. All right, we good? Everyone can hear me in the back? Awesome. Well, thanks so much, everyone, for coming to our first annual Investor Day. This is a very important day to me. We started this business actually 4 years ago yesterday was when I quit my old job, sat down with John and said, let's build this thing. So a lot has happened over the last 4 years, which I'm really excited to walk you guys through. Last night, I was thinking, this is the first Investor Day. It's kind of a big day. Am I suiting up for this thing? Am I going in a tie? Like, do I go tux? Do a 3-piece suit? Like, what the hell am I thinking? I don't even own a three-piece suit. Makes no sense. And so, might not look like typical investment clothing, but we're a little bit different. And that is a line that you're going to hear throughout this presentation, is that we do things differently. We see things differently, we act differently, and it's generated really different investment performance. And so I'm going to start off by showing you guys 3 articles about 3 different companies that you probably have all heard of that were virtually everyone hated them. Every article you'd see in the news was that these were garbage businesses. Carvana. In 2022, everyone thought Carvana was dead. Not only did they think it was dead, they thought it never made sense to begin with. Low interest rate policy, those crazy guys, it never made sense. DoorDash, the delivery apps, they're all the same. There's no differentiation. No one's going to make any money here. This is just venture capitalists throwing money out the window. And Uber, the most famous of them all, they lost tens of billions of dollars. And people thought, this is never going to work. How are they ever going to make money? No one liked these companies. We saw things very, very differently. And we actually owned these 3 companies and were buying more of them as everyone was selling. So Carvana, from 2021 to the end of 2022, went down 99%. That's not a typo. It's insane. This is truly an insane story. There'll be a movie likely about this. Hopefully I'll be in it in some fashion. If people can pitch me, that'd be great. I like this business. It was the smallest position in the fund at $128 when we first bought it. Then we bought it all the way down to $7. That was an interesting ride. Our average cost was $30. Today, it's a $360 stock. This is honestly, it looks like a typo. It's 100x off the bottom in 2.5 years. Crazy. DoorDash went down over 75% from the end of 2021 to the lows of 2022. Our first buy, $100 roughly. Lowest buy, $55. Average cost, $75. Today, it's a $250 stock. It's roughly 5x off the bottom. Uber, you're going to see where I'm going here. It's down 50%. Market-leading business, down 50%. Everyone hated it. They'll never make a lot of money. First buy, $32. Lowest buy, $25. Average cost, around $30. It's around $100 now. It's 5x off the bottom. And so, not only did we see things very differently, but most importantly, we acted differently. And we accumulated shares when everyone else was running to the hills. And because of that, we have been able to deliver exceptional investment returns. And so now we've been in business 3.5 years, and we've compounded at 24.1% annually, which we're really proud of. And this is about, people can benchmark us at whatever they want, but the 4 most common benchmarks people talk about, even the NASDAQ, that has the Magnificent Seven, that no one really can beat, we've been able to compound at a higher rate while not owning a single one of those companies. And so if you invested $5 million with us when we launched, which would have been nice, should have done it. Today, that's just under $11 million. And we still have a lot of upside. And so we delivered this through our core investment principles. And initially, I was going to go into a lot of detail in each of these. We do fundamental research. We dig so deep into all these companies, know them better than everyone. We're concentrated. We focus on our best ideas. Volatility. We take advantage of volatility to maximize our returns. We focus on cash flow. And we're long-term investors. I was going to go into all the details. But when I did a dry run, everyone looked like this guy. And the reason is because every investor, every fundamental investor really, sounds the exact same. We're all researching companies. We're all thinking we're buying great businesses, typically, that are undervalued. We think we take advantage of volatility, and we're focused on the long term. Everyone sounds the exact same. So instead of putting you guys to sleep, I'm going to focus on how we're different. And I'm going to get into the specifics of the types of companies we focus on and how we make a lot of money from focusing on those companies. So what is an optimist company? We invest in ambitious people running ambitious market-leading companies. But this is not enough. We're always investing in companies that meet that, but that itself is not enough. The key link here is where their long-term cash generation is significantly underappreciated. That is the hard part. That is the part that matters. We need to find the significant underappreciated asset. And so how do we do that is a logical question that you'd ask. We identify these underappreciated assets in two ways, which we've named compounders in disguise, which are two great compounders, Bill Gates and Warren Buffett there, wearing Halloween costumes. So I'm sure none of you knew that was Bill Gates and Warren Buffett. And inflecting compounders. So compounders in disguise. These are businesses that have high organic revenue growth, and they have profitable underlying business fundamentals, but they're reinvesting aggressively into growing the business further and generating more cash in the future. And this reinvestment is depressing their near-term earnings and cash generation. And so they might be losing money today, or they might be break-even, or they might have 1% margins. But their core business could have 20% margins, and it's being hidden by this reinvestment. And so companies that we own that fit this mold, a few of them, is Carvana, Uber, DoorDash, and ThredUp. And what skeptics will typically say about these companies, they'll never make a lot of money. Look at their income statement. They've never made $1. The customer's the only, do you see your Uber? It was $5. The customer's the only one benefiting from this. Competition, the second Walmart really focuses on e-commerce. Amazon's dead. Competition's going to crush them. This is what people say about the type of companies that are compounders in disguise. And Carvana was such an amazing example of a compounder in disguise. Because in 2022, when everyone looked at it and said, this business isn't profitable, it never made any money, it sucks, so it's not going to go anywhere, that was just an incorrect insight. If you actually looked under the hood, over half the business, over half their markets were actually profitable. And their two oldest markets were making a lot of money. But the aggregate was losing money because they were reinvesting all their capital into expanding into new markets to become a much bigger, more profitable business. And you could evidence this in the GAAP financial statements too, because you can see from 2016 to 2021, yes, they were losing money every single year in aggregate. But their margin trajectory was clear. It was going in a very good direction, and the reason for that is because all the oldest markets started making more and more money, so the new investment was having a smaller and smaller drag on the overall P&L. We thought it was clear from history. Everyone disagreed. But now fast forward to where we are today. Today, not only is Carvana a profitable business, that's growing actually 50% year over year, which is pretty remarkable given they're the second largest used car dealer in the US. But they're not even, they finally proved out the profitable model. They have more than 2 times the profit margins of their competition. So they have actually a more profitable model than everyone. And everyone thought they were not even a profitable model. This is the stuff I dream about at night. Finding these things is like what I love. So this is our compounders in disguise bucket, which we're good at identifying. Now, inflecting compounders. These businesses are a little bit more traditional in the sense that they have a history of growing revenue and profitability, and it's clear that they are an attractive business from a profitability standpoint. But the market is underestimating their future growth opportunity, which is going to be driven by two things: M&A, so there might be a huge transaction that the company recently did, or a lot of acquisitions they could do that is going to significantly drive more earnings growth than people expect, or the market they're in, they're doing great relative to their peers, but the market they're exposed to is in the dumps. It's doing horrible, and it may have been doing horrible for several years. And everyone's just assuming it's always going to do horrible. And in the great scenario, we find where both things exist. And so companies that fit this mold that we own: Latham, DSV, First Advantage, Ashted, and Teledyne Technologies. And what the skeptics will say about these businesses, typically, oh, this end market could be dead for 10 years. Oh, this has been painful the last 3 years. It could be dead for 10 years. I'm not waiting around for this. Yeah, they've done a lot of good deals. The acquisition runway's done. There's no more to be done here. They're not going to be able to grow as fast. This is just a call in the economic cycle. There's nothing special about this company. This is what they'll say. And so an example of one of these holdings for us is Latham Group. And so they're the leading manufacturer of fiberglass pools. And this is a great business that pre-COVID was growing profitability in the mid-teens. They're a market leader in what they do. They have over 50% market share in what they do. Revenue consistently going, profit consistently growing, and was private equity owned. Then, the COVID boom happened. EBITDA exploded. EBITDA being earnings before interest, tax depreciation. Went up 120%, and so what did the private equity owners decide to do? Let's take this thing public. This is a good time to take public. And that's what they did. And so as you can see from the stock chart, they took it public at a nice price, at results that were just about to fall off a cliff. And so the post-COVID bust happened when, I'm sure many of you have pools, but many pools are financed. And when all of a sudden interest rates go up as materially as they did in 2022, a lot of people decide, I'm going to wait. And so the industry fell off a cliff. Pool starts went down 50%, and Latham's earnings went down 50%. But the share price went down 90%. And that's more than 50. So that's really interesting to us. And so I started digging into this company, and what I saw was a market-leading business run by a guy who owned a lot of equity that was in a market that was the worst. This was the worst pool market in the last 40 years. Worse than the 08-09 financial crisis, which is pretty crazy. And so, what was really interesting is that now the market was so bad, it wasn't getting much worse. And the business, after declining EBITDA declining 50%, they were actually at a point where EBITDA was going to start to grow. And so we started buying at about $2.50. We got a couple at $2.40. Wish we got more. And then we saw the inflection. EBITDA started to grow. And so this year they're expecting EBITDA to grow 18%. The initial signs that we're at this inflection. And so we've been buying consistently, actually, still. And so our average cost is about $5. Currently, it's an $8 stock. But the industry is still at its 40-year low, and this business is compounding this year in the high teens. And so if we stay at this low level, they're going to be able to keep compounding in the high teens by just market share gains. But if the industry ever comes back, which it's likely going to do at some point, I would like a pool. I don't have one currently. The earnings of this business are going to explode. And so we think this is a $42 stock in the next 5 years, which is significantly higher than where it is today. And I said a lot of how we're different, right? And so, like, how are we different with this? Well, let's look. Latham 2027 analyst consensus EBITDA estimate. What are they assuming this business is going to earn? $117 million. What do we think? $200 million. It's a big difference. Now, I wouldn't get overly obsessed with the $200 million. It's not going to be $200 million. It could end up being 205, could end up being 190, could end up being 150. But we have a huge differentiation, a differentiated view here that creates a lot of gap that if they do 150, we're going to make a lot of money. If they do 130, I think we're going to do well. If they do 200, we're going to make a ton of money. And so this is the kind of stuff that we really focus on, having that differentiated angle and catching an inflection in a business before others are identifying it. And so that's our inflecting compounders. We have our compounders in disguise and our inflecting compounders. But we're not perfect. We've made mistakes. We could have done better, actually. We've made some mistakes. And so these are 4 companies that I believed were inflecting compounders or compounders in disguise in some way that I thought they were going to be very good investments and make us a lot of money. And we lost confidence in our thesis for these positions, and we ended up selling them at a loss. And I want to say this, that's okay. It's okay that that happened. Because we don't need to be right on everything. And frankly, we're not going to be, and we actually don't want to be. If I was right on every single thing, it means we're not taking, frankly, enough risk. It probably means we're just in T-bills or something. And so if you look at the history of the fund, we've made 40 investments. 20 of them have been profitable, so 50%. Our winners have generated 170% returns. Our losers have cost us negative 57. In aggregate, that's 113% net return over 3.5 years, which we're happy with. And there's a quote that I look at this quote all the time. I love this quote. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much money you lose when you're wrong. A lot of people are afraid to be wrong. It may result in them not making a lot of money. We're okay with that. And we really focus on this. When we're right, we want to make a ton of money. And if you look at how we've delivered, that's what we've done. All right, so now, the fun part, the story of ThreadUp. We're so lucky to have James here with us today, the founder of the company. So this business has had a very, well, they've had an interesting history in aggregate, but the last 12 months have been very interesting. And so who here has donated clothing in the last year? So pretty much everyone. So ThreadUp is pretty much addressable to, like, you guys are going to understand the ecosystem of which they play in. So they have something called a clean-out kit, which are these bags that you fill up with the clothes that you don't want. They get sent to these gigantic facilities that have, I think, 4.5 million items right now? 4.5 million unique items of people's stuff in over 1 million square feet of fulfillment capacity so that they can offer an e-commerce experience that's modern while all us lazy people that don't want to be selling stuff online can just fill it in a bag and then just tell us, okay, do we get any money from what we sold? So this is a really interesting business because, it's an online marketplace, but it's not eBay where it's just aggregating buyers and sellers. They actually are running these huge facilities. So it's very different. So they went public in 2021 at a time when everyone was very excited about e-commerce. And I was very excited about learning about ThreadUp because I thought to myself, when I looked at the results, I had been looking at the resale industry, and then I looked at their business and these facilities they had. I thought, this is very different. Not a lot of people are doing this. And when I'd ask other marketplaces, they'd be like, yeah, that sounds pretty hard. I had met with James around this time, virtually, because that was back in the COVID days. And I thought, this is a really interesting business, but I'm not sure, this is new to me, so I don't have the conviction to say I'm interested right now, but I definitely want to follow this company's path. And so that's what I did. I threw it on the watch list, and I followed the results. And over that time, we had this growth scare, where everyone said, oh, you're a high-growth company losing money? Yeah, we're not interested. And the share price collapsed, went down 97%. That definitely didn't feel good, James. I can't imagine. Yeah, didn't feel good. But although the share price went down 97%, they were actually having some material progress in the business. And I thought it was very interesting. And so by March of 2024, they had finally gotten to a point where the U.S. business was profitable. And to do that, to go from losing a bunch of money to profitable, it really proved out that there was a lot of operating leverage in this business, and they were going to start getting the benefit of all these investments they've been making for years. And so we started with a smaller position, as we typically do with new positions, and then we want to gain conviction. And we thought, if this business can accelerate growth and hold their unit economics, their profitability is going to explode. And the stock is still down 97%, which definitely does not reflect that. And so, November 2024, their Q3 earnings, they came on and said a bunch of stuff that was actually really material. Like, you can go back and read it, and I can literally say, like, yeah, those words mean they're going to accelerate in the next 9 to 12 months. Like, probably sooner, frankly, but like, let's be, I don't want to be overly bullish here. Probably in the next 9, 12 months, their business is going to accelerate if there's not some sort of crazy left tail event. And so we bought a lot more because no one else was talking about this. And the stock didn't go up after them talking about this. And so we bought a lot. And then over the next 9 months or so, the stock has gone up 20-fold from the bottom. Now, I wish our entire position was built off the bottom. It was not. But we were able to accumulate shares at an average cost of about $1.75, and today it's a $10.50 stock that I think there's still significant future runway for this company, and we still have a very large position in the company. So now I'd love to have James up on stage so we can ask him some more questions about this business he's created. You go there.
How's everybody doing?
Good.
The chart's both painful and exciting.
Yeah. After when I said, that didn't feel good, I thought to myself, well, that's kind of stepping on a bruise.
No, I like to say that I've founded a company, I've taken it public, and I've done a turnaround. So I've checked all the boxes in the same company.
There you go.
That's good.
So your background is very unique, I'd say. It's not the typical path. You went to university to become a teacher.
Correct.
And now you are an entrepreneur running a company. Can you make sense of that for us?
Yeah, I went to Boston College. I was a history and a philosophy major, and I was really passionate about education. But I was in education as a way of change. Like, I was really interested in improving public education. So it was less that I was interested purely in being a teacher, but I thought there's got to be a way to fix this problem. So I graduated from Boston College and actually went and helped run a charter school, and I was really focused on public-private partnerships in education. And I think the through line in my career is that I wanted to do things that I thought, yes, could do well for me, but they would actually do well, do good in the universe. And so it's actually a pretty tight line from the work that I did, teaching and helping build a really successful charter school to business school and what I did there with the joint degree at the Kennedy School, and then founding ThredUp. So it's been, and look, the hardest thing I ever did was a room full of 8th graders. So this is easy. You should show the emotional chart of managing 8th graders.
Yeah.
Right? Much harder than that stock chart.
Hell, I only know from having a 4 and a 6-year-old that my wife has a much harder job than I have, frankly.
Exactly.
So you were at Harvard.
Yeah.
You wanted money for your clothing.
Yeah. True story.
No one would give you money.
Yes.
Did you look internally and say, maybe my style sucks?
It crossed my mind. Yeah, I mean, a true founding story. So as a teacher, and I did a joint degree in business and public policy. So Harvard Business School, Harvard Kennedy School, and which is a long way of saying that I didn't have any money. Like, I mean, I had, like, some of my friends came from McKinsey and banking, and they had plenty of money at business school. I was not one of those kids. I said, what is the maximum student loan that I can take out? And the woman's like, you can take out this much. I was like, can I take even a little bit more? She's like, yeah, you can, right? I maxed out my student loan, so I was really living on borrowed money. And then I had a closet full of clothes that I didn't wear, and I went to take them to a local consignment store. And they said, we don't take these. We just do luxury. And at the time, this was a J. Crew cashmere sweater and a Brooks Brothers coat. And some lady, 22-year-old sassy woman at the counter, said, "This is worth zero." And so and I think this is like the instinctual part of me has said, well, that means this thing is broken because this stuff isn't worth zero. It's worth zero to me because I'm no longer wearing it. But like, there's real value. And so I was in business school at the time, and I was spending a lot of time thinking about marketplaces and how value is created. And so I went home that day, and I was like, this is interesting. And then I literally went to school the next day, and I'm in line, like at the cafeteria, and I just started asking the women in line. I was like, hey, what % of the clothes in your closet do you wear? They're like, I don't know, less than half. I was like, what do you do with that stuff? Like, I don't know. I'll just give it away. And it's like, literally, I went to class that day. I was like, started doing math. I'm like, okay, Harvard Business School, 900 kids, half of them are women. And just like thinking about the value in those closets.
Yeah.
And that began this like journey of really working on the business plan in class.
Yeah. So then you were experimenting. You started with peer-to-peer.
Yep.
Then you eventually have gone the trajectory that you've gone now, which is we're going to do all the work for everyone. We're going to make it easier for people.
Yep.
Maybe how did that come to be? And how did, like, what was the, I want to know, like, the first, when you did that, what is this? Was in your bedroom, you know, someone just sent you a sweater, you're like, oh, this is interesting. Like,
so we started peer-to-peer. So this is like 2009, right? So financial crisis, venture capital investors were backing it. Everything had to be asset light. So like the prevailing wisdom is don't touch stuff. Like it's very expensive. Operate in ones and zeros. And I was like, oh, okay. Well, so we started peer-to-peer. And then I quickly realized that the friction, right? So if it's ultimately about building businesses that solve customer problems, the friction is people are lazy. Like they don't want to list all their stuff. Like you want to fill a bag, and put on your doorstep, and get rid of that shit, right?
Yep.
And so the idea of solving that I became obsessed with because, and it took some time like to get there.
Yeah.
But ultimately the idea was figure out the most convenient way to get clothing out of people's closets. And so, so we started peer-to-peer, we raised some money, we moved to California, and then, 9 months into that, I was like, this is not going to work. Too much friction in the process. So we launched these clean-out kits. And when I mean launched these clean-out kits, we bought like 200 white bags on Uline, printed stickers on the printer in the office, slapped them on there, went to the post office, grabbed some labels, put them on there, and we asked people to order them. And my co-founder, who's Canadian, nicest guy, he's like, this is never going to work. This is like never, and sure enough, Jordan, like 10 days later, we come into the office, just to paint this picture for you, it's this second floor walk-up office, it's in downtown San Francisco. We walk up there, and the doorbell rings, like 9:30 in the morning. There's a guy, postal worker, comes up. He's like, are these yours? It's like, yeah. I still have this picture. I was like, please, stand right there. I need to take your photo. And I have it. It's like an amazing photo.
That's awesome.
And then his next time he says, I got 18 more downstairs. Can somebody help carry these up? And that was the beginning. I was like, okay, this is like an 18% hit rate on the 100 bags that we sent out.
Yeah.
There are very few things without any education, nobody knew anything that like, and at that point we like burned all the boats and was like, we're going to launch this new marketplace. Like 30 days later, I was like, where are we going to put all this shit?
Yeah.
Like the office now
Where'd
has
they go?
more bad, right?
Are they just filling in the office? They're just stacked in the room?
Yes, they're stacked, and people are like, okay, we got to do something with all this stuff. And we went and got a short-term lease at a warehouse in San Francisco, because where you should put all your distribution facilities is in downtown San Francisco, especially with like an uneven floor. And I remember negotiating with the guy. The guy's like, yeah, you want this space? I'm like, yes. And he's like, when do you want it? I was like, right now. And he's like, okay. I was like, I would like to prepay 12 months of rent, because that was the only way to. And so we prepaid 12 months of rent, and we opened this facility in downtown San Francisco, and then it was.
So now you can like YouTube their facilities today, and they just look like enormous dry cleaning stores, and they look pretty sophisticated and advanced. So like, what has been the journey from presumably all people being in a warehouse, just sorting and taking pictures, to like where you are today from like an automation perspective? And is it like as automated as it can be today, or are there still more frictions that you can take out of the process?
I loved how much you talked about people in the presentation, because I think so much of the ThreadUp success story is about the people. And so the automation journey happened with a guy named John Voris. So John Voris started ThreadUp in 2012. So John Voris was the chief operating and systems officer at Netflix DVD. He was like a world-class industrial engineer. He's actually, if you ever who has had the DVDs, like Netflix DVDs ever in your house, right? So if you've had Netflix DVDs in your house, has it ever occurred to you, how does Netflix know that this DVD is going to play correctly? It turns out, like, there's a whole technology around like making DVDs readable. John Voris is the guy who invented that. Just to like give you a sense, like he spent a year inventing how Netflix could read DVDs to ensure like integrity in the process. So like an incredible engineering mind. When John started at ThreadUp, the person he was working for before ThreadUp, Elon Musk. And then he got stuck with me. Right? So I say all of that because he was building the SpaceX rocket program, and then he wanted to work on something harder, which was use clothes on the internet, right? And so his vision was that nobody had ever done this before. I was like, John, I want to build the world's largest dry cleaner, right, that doesn't clean anything, right? And he's like, right. He's like, and we're going to move shit around on carousels and conveyors, and we're going to invent everything. And it had never been done. So I mean, the story is very much this contrarian point of view of we're going to process all the stuff. And then we were right around the fact that we could automate this over time. But in the beginning, every order we shipped, we just stapled like a $20 bill to it, right? You know, you lost money on every order. To your point around like the unit economics and like, so we had to figure a bunch of stuff out. And today, the business now is highly automated. I think on any given day, we're processing about 150,000 pieces of unique clothing in. So we sell 35,000 brands across 100 categories. 4 big facilities, and there's more to come. And so the first 500,000 photos of clothing we ever took, we took using an iPhone and an iPod Touch. And now if you fast forward today, like garments go through this like smart station, has a 6-camera like video array, lasers, processing these goods. And I think there's more to come.
There's more to be automated.
For sure.
Just taking labor out of the system.
Labor out of the system, and I think the big and I hope we'll talk about AI in a minute, but like I never quite imagined how fast sort of generative AI would improve the process. And so
let's touch on that.
Yeah, so the one thing that's not in the stock chart, so there's the inflection point in the March 24 earnings that Jordan's mentioning. That's also when we announced this big layoff, right? And I said at that time, and you're so right to think, like, sometimes I write these earnings calls, I'm like, and then things happen, I'm like, does anybody fucking read these things? Like, I'm telling you what is going to happen. Like, I can't be any more direct. I'm telling you we're going to do these things, and right? And I've been and so in March of 24, I talked about that we'd sort of burned the boats and been really focused on AI search and some of the AI investments. And so the combination of us getting rid of our European business, which was, I think, also like a big part of the 2024 story, and AI has just meant that the product experience has exploded with potential. So one of the biggest challenges in secondhand clothing is you do have this long tail problem. Search is very hard. tagging items. So if I were to ask all of you, like the classic joke is, if everyone would just point to the barcode on your clothing. Anyone? There's no barcodes on clothing. Look, we've got probably, in this room alone, like 100 brands. We've probably got a dozen categories. There's no structured data for how you do this online. And so AI has been this like incredible like accelerant for us in cataloging all the data. So we used to have to take everybody in this room's clothing, and we would attribute it. That shirt, it's this color, it's this brand, and they have these variables. Now we hit it with the camera, everything we want to know about the item we have. And the power of that is not just that we get high fidelity photos and attributes, it's now that all of that is searchable. Mm-hmm. And so now, like, if we were able to index this room's full of clothing with one query, I can find exactly what I want. Mm-hmm. And AI has enabled that in ways that I think are very powerful. And then from there, we're just building products on top of that, which is why the conversion rate in the business has been like a step function change.
Yeah, from what you've said, it seems like the materiality of AI has driven people to be able to buy more in a more convenient manner.
Yes.
But what I'm curious about, because obviously supply is like so important, like unlocking the supply. So many people are bringing their stuff to Value Village, Goodwill, that you would like them to put in a clean out kit.
Yep.
Is AI doing anything that can like improve how you get supply?
I think it allows us to improve the accuracy of what we take out of the bag. So I think we're able to accept items at higher rates because we understand better how they're going to sell. We can price them better, and so we can create more value for the seller. And so I think if you're able to create more value for the seller, that seller then is likely to repeat more. They're likely to tell their friends. We're also using it to sort of mine the data on how to influence what people send us. So whether it's a spring assortment, a fall assortment, we're using the power of that data set to influence that. But I think like where we're headed also is what are the things that the customer can also do with AI technology. Yeah. So for example, like we're working on something right now where I could just video your outfit right now, and it might pop up and say, "Oh, this is
in my closet." Just
exactly like this is now. Oh, Jordan, today this is worth $33. If you hold on to it for a year, it's likely to depreciate to $24. So right, and so to give customers and sellers that type of data.
That's really interesting. So when was it that you obviously experimented with building the business and having to make it work, having to automate to get the unit economics to where they are today, which is really attractive? Yeah. Was there like a moment where you're like, oh shit, we could do this? Like this is gonna work?
Yeah, I mean, I think that there's a few like moments in the company's life. I mean, one was seeing like the automation carousel conveyors like come to life in a way that allowed us to like 10x like the throughput through the facility. You started to get to a point where gross margins were, okay, now they're 20%. Like we used to have a joke in the office. I would put up these big things like GM 20, and it was like, how do we get gross margins to 20%? And of course, I'm known as the guy who's like, the minute we hit 20, it's like GM 30, GM 40, we're at GM 80, right? Gross margins in business are nearly 80%. And it has come through process automation. It's come through just like really feeling like the market is starting to like understand. Yeah. So I think your point about founders and like I've been with those guys, very Jeff Bezos like in the sense of I'm willing to be misunderstood for a long time. And, you know that's his quote. What he was building, people did not appreciate in the beginning, and we're not going to be Amazon. So, but I think the idea is that. You have to be willing to do those hard things that are only appreciated over the long term. Yeah. And we've been doing that, and we're still in this investment cycle. Like I still think the work that we're doing on the technology side and in our DCs is going to create cash flows in the future that are going to blow people's minds.
So 20 years ago, TJX was under $1 billion market cap company. Yeah. Today, TJX is a $150 billion company. Yeah. And there's actually quite a few off-price retailers that have all done really, really well. Yep. Off-price has just been a great spot. Yep. So how big could ThredUp be?
Look, I don't know how big how do I answer that? I think ThredUp, I think the second hand, let me start with the market, right? So I think the thing that people don't appreciate about TJ Maxx is, so TJX is a $150 billion company. It was started in 1982.
Yeah.
It's been a long journey, and in their first few decades, it was educating and proving to people, and this is really important, educating and proving to people and the market that people want to buy off-price clothing, right? That they want to go to a slightly less attractive store. They want to dig through some racks. Mm-hmm. Every time they go there, things are different. Mm-hmm. They had to teach people that was a really fun and enjoyable way to shop while delivering great value. They have stuck to that strategy for 4 decades at this point, and they are now they have created this market that they now dominate. Mm-hmm. And the reason I explain it like that is I think we are still in the ages of explaining to people why secondhand works, mm-hmm. why it makes sense, the joy of it. And I think you have successive generations now of young people who are growing up for whom, if you have a teenager in your life right now, and you went home and talked to them right now, they're shopping secondhand all the time. I mean, all the time. And it's not I encourage any of you who have teens, ask them, and you'll be shocked at how often they think or talk or their friends talk about thrift. To me, mm-hmm. that is the most compelling thing about what's going to happen in the future. Mm-hmm. Because what you see is that people in the off-price industry, once you've gone to TJ Maxx and you get a great deal on whatever it is, or it's Nordstrom Rack, pick any of the off-price guys. You know what you don't do is you know what? Next time I want to pay full price.
Yeah.
This was so delightful and cheap, so great. I should pay 4 times more the next time I want to have this experience.
Yeah.
Right?
Yeah.
And in secondhand, the same experience is God, I got this dress. It was $14.
Yeah.
I don't think I'm ever going to buy a new dress again.
Yeah.
And so what you see in the cohorts is this stickiness and wallet share growth. And so that's a long way of saying, I think this industry is massive. I still think it's underappreciated. And I think ThredUp is so well positioned to just dominate wallet share over time, because to compete with us now is a monumental task. Yeah. And so I think it's going to be a big company. I'm not sure it's going to be TJ Maxx, but it might be.
Does anyone have any questions for James? Justin?
Are you ever going to go beyond clothes?
At some point, I think it would make sense. But I just referenced TJ Maxx playbook for a while. They became just so good at the TJX retailing aspect that it's sort of an impenetrable model. And then eventually they moved into home goods and they did some other things. So what I would say is that the platform and technology is built to do other things. So those carousels and conveyors, they can hold totes. Those totes can hold up to 25 pounds. So what I would say is if you think about the number of things we could sell secondhand under 25 pounds, it's a big number of stuff. Yeah, I mean, Once Upon a Child is Once Upon a Child, Plato's Closet, all these guys. Winmark's been a public company for a long time.
Have you met him, the CEO?
He's a Boston College guy, Brett. Yeah. But I think there's so many extensions, for the business. But I do really want to stay focused on building core competency.
Maybe one more question from someone, Todd.
How committed are you to scaling up? If Amazon people are trying to buy you
now. I think they'd. Sean, CFO, is right here. Raise your hand, Sean. Sean and I, had a drink last night, and we were coming up with numbers that would be required, right? And they were big numbers. So look, we're fiduciaries, but I don't see a path where that makes a lot of sense without a really big number.
Okay, last question for me. We got one more? Okay, yeah, we'll do one more.
Sorry, you left the European market.
Yes.
Because?
So we bought a.
The U.S. is the biggest market, or?
Yeah. So in end of 21, we bought a similar type of business in Central and Eastern Europe called Remix. At the time, the world was a different place, right? In 21, and in 2022, as interest rates, spiked, inflation in that part of the world was 15-16%. And so that business then began to struggle. It was a business that was growing and EBITDA positive, And when inflation hit 16%, it was now like flat and losing money. And so we spent like a year trying to turn it around and ultimately divested from the business end of last year. I still think there's a global opportunity, for this, but I think Remix was a challenging thing for us to make work. And I think it points to Jordan's, insight in the inflection point, which was we'd been saying quarter after quarter that the U.S. business was EBITDA positive, and that the U.S. business growth was being constrained, right, by our European business. And so once the European business was gone, we could take all the cash flows that the U.S. business was generating and put them back into the business. And so it's like a high correlation of us being able to invest in the U.S.
So lastly, you took out student loans. You had no money. You start this company. It's effectively a dream.
Yep.
So, okay, we're going to start this new business, build these facilities. Everyone doubts you. Now, you're what? What are we, 2025? You're 15 years in, pretty much.
Yep.
Billion-dollar company. You own 8 million shares. Are you going to be running this company 10 years from now? 5 years from now? Like, how do you think about like your motivation to build this into a materially larger company?
It's such a funny question because nobody asks teachers if they're going to stay in the classroom for another 10 years. Like, there's so many professions out there where, like, how many people do you get off? Like, hey, where are you going to be in 5 years? Are you going to still be doing this in 5 years? But for founders, people love to ask this question. And the answer is, like, I love doing this. Like, I am a builder. And I think if I can keep building, so if I won't be running the company if it's exactly the same as it is today. Like, what I love is the building. And I think there's a lot of stuff, like, still to build. And so is it 5 years? Is it 10 years? Is it 15 years? Or is it 20 years? Like, I'm not sure. Like, I'm not sure the window. The greatest founders that I, like, spend my time with, that I respect enormously, they have stayed with, like, Reed Hastings, co-founder, CEO of Netflix, good friend of mine. And, he ran Netflix for, like, 25 years. And I remember over years, like, he's like, yeah, sometimes it sucks, sometimes it's hard, but like he loved building. And I think Netflix is one of the greatest companies like that's ever been built because they've been able to do three things well. They built DVDs, then they built streaming, now they're doing original content, now they're doing games as the fourth thing, right? And so I think we're Act 1 with ThreadUp, and I think my dream is that we've got Act 2 and Act 3 like right behind this, and I think if we do that, you'll probably see me for a long time.
Great. Well, on behalf of all of our investors in the room, we thank you for your hard work.
Yes.
You've made us a lot of money, and we're very excited for the future of your company. So congratulations, and thanks so much for joining us today.
Thank you. Appreciate it.
Come on. It's a good story. It's a great story. All right. Where are we now? So I hope now, what have we done? We've talked how we're different. We've shown how we're able to identify things that other people are missing. We've given you an example of a great company that everyone left for dead that we identified had a significant inflection that was going to unearth all this value. So what's the future of Optimist? And I've been getting this a lot lately of people saying, oh, yeah, congrats, it's been really good. I just feel like I missed it. Like, I wish I invested like 2 years ago. And before I talk about the portfolio, I just want to say, well, since I started, there's always been a reason to not invest. Start off too young. Too young, no track record. Oh, the fund's too volatile. Oh, yeah, what are you doing buying these companies? Carvana, that's going crazy. Then it's your performance isn't good enough. Now it's turned to your performance is too good. This is like, I don't want to be the guy buying it at the top. Yeah, we've missed it. Not interested. And if there's one message I want to have with you guys is that there is no part of us that's saying the last 3.5 years has been great and let's lower our expectations for the future. We've compounded at 24%, and we still see a lot of underappreciated value and some really attractive opportunities across the entire fund. And so we are concentrated in our best ideas. And so our top 10 holdings today are the companies that you can see here. And a lot of them I've already discussed. DoorDash, Uber, ThreadUp, Carvana. We have some other holdings, Latham as well. We have some other holdings, First Advantage, Wayfair, that we think are early innings on ThreadUp or Carvana or Uber or DoorDash type inflections. But we still like ThreadUp and we still like Carvana because we believe they're still significantly underappreciated. And I also want to make sure everyone understands that we find new ideas. We love, Brandon and I, who I'll introduce in a moment, we love finding investment ideas. That's like what gives us energy. My wife constantly tells me, get off your phone when I'm in bed because I'm searching through some new company, going through their investor presentation because I just love it. It hits me with endorphins. And so we're always finding new ideas, and these are what we call the hungry bench warmers. They're newer, smaller positions that eventually, some of them, will make it to our top 10 holdings. So we're excited. And so I hope you guys see that we're 3.5 years in. We're not a startup fund anymore, 3.5 years in. But we have decades of compounding ahead of us. This is very, very early innings. We have a different way of looking at things that has driven really strong returns that we're really proud of. And I'm 34. Brandon's 46. And he's a spring chicken at 46. You should see the guy on the pickleball court. And so we're going to be doing this for a long time and working our asses off to make you guys a lot of money. And so with that, I would like to bring my partner, Brandon, to the stage, and we'll get into Q&A. But first, let me just introduce and express how lucky I am, and we are, all of us investors, that I somehow was able to convince Brandon to join me in running Optimist. So Brandon is an exceptional investor. He's an exceptional person. He went to Laurier like I did, then moved to Boston, was a rising star at Fidelity, took over $1 billion strategy before he was 30 years old, then followed his mentor, who's a guy named Alan Radlow, to CI to build where I was hired, which was called Cambridge Global Asset Management, a division within CI. When Brandon joined, they had, I think, $2 billion of assets. And over 9 years, that went to $25 billion. And that was because he, and the help of other people, I like to think I helped somewhat, delivered exceptional investment performance. And he knows me so well. We've known each other for 14 years. So, Brandon, why don't you come up here on stage, and we'll start hitting the Q&A. All right, so we have a mic, and we also have cue cards. So if anyone has any questions, now is the time to ask them. Good work? Yeah, why don't I'll start it off then.
You going to start?
I'll start it off. So why did you...
We got a question here, actually.
Okay, where are they? Yeah.
So I'm one of the guys who recently invested, actually.
Yeah.
Just for everyone else. My question is, you have a company like Carvana.
Yeah.
It's got a tremendous upswing. It's doing great.
Yeah.
At what point do you say, I've made a lot of money on this, and the next thing that's up has greater growth than Carvana has? Because once you've achieved certain growth, the opportunity to grow that at that same rate diminishes. What's the inflection point where you start to say, this is done really, really well, I could take my money or reduce my position and put it into the next great thing? And do you go all in at the beginning, or do you take a measured approach, which you've done in the past?
Great question. So we are always valuing every business we look at. We have a view on what their fundamentals are going to be over time and what is the fair value of the business based on that view of their fundamentals. So Carvana, we have a target price today for, and for ThreadUp, we have a target price. And that's always over a 5-year period. And so we're always weighing all of the companies that we own in the portfolio based on what the upside is and what the downside is, and our conviction in both of those things. So we have sold, like we've trimmed Carvana significantly as it's gone up, and bought other positions. Like we bought a lot more ThreadUp when it was a very attractive risk reward. And so we're always doing that to optimize for the best 5-year return profile. So that's the one point. The second point, when we buy a position, we always start small. To us, small is like 2 to 3%. So that might be big to some people, frankly. But that's, for us, we don't want to have 100 names that we have these tiny little positions in. And so it allows us to buy companies that we don't actually know that well. By the fact that our smallest position is 2%, we always really know the business. We always really like the business. And we'll start there and then see, okay, are things playing out like we thought they would when we first bought a position? And if they're moving in that direction, then that's what would drive us to increase the position because we have more conviction in our upside case.
Yeah, I just add to that too. I think historically when you look at investors, and it's proven out in the numbers as well, that more money is lost by investors selling winners too early than it is actually for them holding on to winners too long. If we are identifying the right companies that are ambitious, that we have CEOs that are thinking ahead of the curve, what the market sees and appreciates is not really the true total story. So that's what's really nice about investing in these type of businesses, because they're often surprising us on the upside. You know, they're coming out with new things, like a few of the things James mentioned today we didn't even know about. And it's exciting, and it's great. Having those type of portfolio companies, you can actually be it's not that you're passive with the position, but you're, a content sort of participant, a rider on the same train or the rocket ship they're on. The other thing that Jordan mentioned briefly, which I think is important, is we do constantly re-underwrite our positions. So he's the one that is initiating a lot of the portfolio ideas. He's the one we're discussing. He's building up the positions. And I'm kind of the one that's sitting back and looking and going, hold on a second. Let's pump the brakes a bit, or did we look at this right? What about this thing we haven't thought of? So I'm kind of the investing angel on his shoulder, just keeping them focused, bringing them down to earth, and we're doing that constantly, just every day, going back and forth and discussing these things.
Jordan, I think you've done a great job this morning telling us how you identify upside in names and companies and management teams, people. Over the last 3.5 years, do you find yourself getting quicker at identifying the risks and when you are ultimately deciding to jump ship on people, on companies?
Yeah, I would say the biggest the thing that I've gotten, what I'd like to think I've gotten better at, my biggest mistake would be not cutting a position quicker. And so what I realized with some of my bad investments was there were more cockroaches forming that I probably should have been shrinking the position as they were forming. But instead, I still believed in this long-term thesis. And so now I'm much more, I would say, we're much more tactical in the sense that we really want to see a business tracking to our upside case. And if it's not tracking to our upside case, we're probably going to shrink the position. Doesn't mean we're going to sell it, but we're going to shrink it. And so we're much better at cutting a wrong thesis very quick. So I would say that's like the biggest element that I focused on.
Yeah, I would just touch on that as well. Being a investor for 25 years, when people come up with ideas, especially when they've done a lot of work and have a lot of conviction in them, it becomes a bit of their personality in a way. The one thing I would say with Jordan, since I've worked with him for nearly, known him for nearly 15 years, worked with him probably 10 of that now. Yeah. He's the person who would come into my office and say, I have this idea and this is what I'm seeing. And I'd challenge him on some points. And he'd say, that's a really good point. There's a humility that he has that I think couples really well with the confidence. So, and since I've been working with him the last 18 months, my role, again, has been, he has this vision, what this thing can be in 5 years, and I'm the one watching as things progress and saying, okay, well, this seems like that's not what we think is going to happen. Like, this thing that happened is actually counter to what we think is going to happen. And so I think that we've always, worked really well in this regard, but the two of us together and me having that, that eye on things has helped out. I don't know what you feel in the last, whatever it has been.
Yeah, Brandon has been a game changer joining our team. The thing that is so great about investing and what Brandon helps so much with is that there's so much information coming in across a lot of different names. And so when I'm seeing things and then conveying what I'm thinking about it to Brandon, he is always able to distill and find the holes in what I'm thinking. Like, oh, have you thought of this? Have you thought of that element? Even the ThreadUp situation. ThreadUp had some things that happened that were negative in 2024. And after driving up to Waterloo, sitting with Brandon in a coffee shop for 3 hours thinking, okay, what specifically do we need to know to have conviction that this thing is solved and is no longer going to be a problem? And just having his intellectual rigor as well as knowing me so well, honestly, it's helped so much.
With coming back to the theme of you've already performed extremely well, looking over your shoulder at market returns the last 3.5 years, they've been very strong. Do you find your opportunity set is smaller now for new investments than it would have been 2-3 years ago? Or is it really independent of market?
I would say 2 years ago, yes, because 2 years ago a lot of companies were fully left for dead, and might add over the last 2 years we've compounded at 55%. So, but I would say when we launched, and over that time we've compounded 24%, I would say I see just as much opportunity today than at that time. There are a lot of businesses that, even though the S&P is at all-time highs, there are a lot of businesses that are in markets that have been horrible. Absolutely horrible for 3+ years. And frankly, I was going to go into it, but 3 of our holdings that are all top 10 positions, Latham, Wayfair, and First Advantage, all of them are in markets that were declining for the last 3 years. And last quarter was the first quarter where they all grew organically, which was the highest growth they've had in 3 years. So we see some very idiosyncratic, specific opportunities that I think are very similar to the opportunities that we've identified 2 years ago.
Yeah, I would say too, just on that, at Fidelity, I asked Peter Lynch the same question, and his answer was always, there's a bull market somewhere, right? You just got to find it. The market structure today versus when I started 20+ years ago is very different. I think passive investing is the biggest incremental allocator into the market. Now, what people don't appreciate enough is passive investors are price takers, okay? So they're not price sensitive. They're not looking at the S&P every day and saying, is this the right price? What's the upside downside? It's just a passive allocation. So you get a couple things with that. The one thing you get is the markets have done well in the last 3 years, but what has really done well, right? Concentrated in the largest market cap companies. I would say that the overall performance that's been concentrated in that just sort of it hides the difficulty a lot of areas have had underneath it. The second thing that does is when we do have things like the tariff shock, what happened in 2022, COVID, all these things, the buying just shuts off, right? And then you have these hedge funds, and they have all these value at risk calculations they have to do, and they just have to liquidate. Mm-hmm. So you get these massive drawdowns, right? And that's if we do have our list of bench warmers, if we have another 50, 60 companies we're waiting for, it's like kids in a candy shop. That's the time we can get out there and be like, oh my God, I didn't think this would ever happen. This is amazing. Mm-hmm. And once that passive flow comes back, you see the markets recover very quickly. And people forget this, but even in COVID, the world shut down. Everyone was going to die from this virus, right? March 2020, everything collapsed. By November, the market was at all-time highs again. So I'm just saying that there's opportunities underlying the overall market returns that we see, but at the same time, the structure of the market is giving us these generational opportunities in a lot of situations when you have that shock where the passive turns off and then everyone runs for the exits. It's for me, 2003 to 2015, let's say, was a good time to invest. There was a period in there where it was more difficult because everything was kind of rising. But this is I'm super excited about investing again after taking 5 years off to do what I did because the opportunities are there again.
Oh, there's a question in the far back.
Yeah, I think you answered the first one I had already. But given how many companies create so much value before they go public, is there any thought in the future of expanding the fund's offering to early stage, maybe not early stage companies, but later stage companies still private? Because a lot of value has been created in that marketplace. I'm just curious if there's any idea of you guys expanding and putting into private placements at some point.
Not serious consideration, but like James said about his business, I plan on doing this for many, many decades, so I wouldn't ever say never because I don't know what I'm going to be thinking when I'm 50 years old. But right now, no, we see so much opportunity in public markets, and frankly, I think public markets are actually the place to be. People are paying more to not have daily prices go up like this, and I actually like when prices go up like this because it allows us to find opportunities, make more money. Carvana, if it was privately traded, would have never went to $4 ever. Would have never happened. ThreadUp would have not gone to 50 cents. No, if venture capitalists all owned it, no one would have been buying at 50 cents. So public markets are great, and we see a lot of opportunity. That's our skill set, so that's what we're going to focus on.
Hey, thanks very much for this morning. And so, Jordan, congratulations on the performance, as well getting Brandon back to the fray. I was privileged to cover Brandon on the sell side as a trader for I don't know how many years at Cambridge. So my question to both of you guys would be, how has your investment approach differed from the value approach of Fidelity, then at Cambridge, and now with the freedom at Optimist?
You want to start with yours? Because you can go even more historical.
Right. Absolutely. Back in the day.
Tell us about the Stone Ages.
So I would just say that when Jordan launched Optimist, I was super jealous, okay? Obviously when you're looking at investing, it's about the people, but in this case also the product was really enticing. The concentration of the portfolio, the long-term focus, the flexibility it has to go anywhere is something that any bottoms-up real fundamental investor always wanted to do. But you can't do it in a mutual fund space, When I was running mutual funds, I had a meeting with I won't say where, but with a consultant who had some money in our fund. And I had about 15% of the portfolio in one group of companies that were sort of related. And I went back to head office and I got told, you can't do that. Our relationship is at risk now. And the companies were Loblaws and Shoppers Drug Mart before it got bought. Simple, boring, stable businesses, but based on their risk metrics, it was just too much exposure, So investing is completely different with Optimist, being able to take that long-term view, being able to concentrate your best ideas in real numbers that matter in the portfolio, and not having to manage to arbitrary guardrails and boxes you have to fit into like you do in the mutual fund company. It's night and day. It's way more exciting and way more fruitful.
Yeah. I love this question because effectively everything about Optimist is my own experience of working in a mutual fund company, seeing limitations and being like, why in God's name are we not doing things differently so we can make way more money over the long term? And so, most public companies are just very short-term focused. If you told them, hey, this company is going to be worth $100 billion over the next, it's a $10 billion company today, and we have pretty high conviction it's going to be worth $100 billion in the next 5 years. But, the a lot of people that own it, it's pretty volatile. Stock goes up and down 5% some days. Something goes down to 10%. Whoa. Let's not do that. We can't do that. That doesn't make any sense. Like, I really think there's some people that are interested in actually being long-term investors. Actually, I find most people are actually long-term investors. They might need to be told a lot of what's happening while it's going on, but like most people actually stick around with their investments for a decent amount of time. And so I just saw that the industry effectively appeases to the 5% of people that are jumping ship constantly, and the 95% that actually will stick with you for the long term are like getting lower returns because the sales guys are trying to hold on to those 5%. And so that to me makes no sense to me. And so that's why I was so passionate about doing things this way, and why when people would say, you have 20 holdings, yeah, you should probably get that to like 40 holdings and like put in a couple other companies that like, you just know are always going to be like, they're not going to move much. I'm like, I will be poorer in 5 years if I do that. Why would I do that? And so, yeah, you've hit a bruise that I have attempted to mend with creating Optimist and find people, hopefully like all of you, well, I know half of you or all of you that are like, yeah, let's just make a lot more money over the next 5 years. That makes sense. And that's what we're going to do. That's what we focus on, and we think there's going to be a decent amount of people that will do that. All right. Do we have any more questions? Oh, Bonnie.
I have a question. First of all, I'm really excited to see you both up there, and thank you very much for hosting us today. That's fabulous. In regards to what you can do in the fund, can you open it up and say, hey, I can do anything I want? Can I do...
No.
Okay. And then when you see FOMO in the market, do you draw down and get yourself ready? Like, do you see that sort of...
So one, we can't do anything. So we are not going to put more than 15% of capital in one position. We're always going to own in between 15 and 25 stocks. So we are diversified, though concentrated on some names. We're not ever going to be a one stock fund. So we do have like risk controls from that perspective to keep diversification. In terms of the FOMO doesn't really mean much to me, to be honest. Because I'm just looking at the value of companies and what I'm able to see what's happening with the business. So I spend all my time focused on identifying when people are misperceiving what the financial performance a company is going to produce over the next few years. And so everything that we own is always, like, I always feel like I have this big margin of safety because people would say, oh, this stock's going up and down. But I'm like, everyone thinks they're going to earn $100 million. Like, I don't know how that's possible. They're going to do 140. And it's hard to find those. Frankly, it takes a lot of time and work. But that's where we're focused on. That's our value add. That's really our differentiation. So I don't like, that's what governs me. Not like, oh, people are buying this company or that company, and there's like a weed company that went up 1,000x or something like that. That's how I think about that. How about Brandon? What do you think?
I think it ties a bit back into, what we're saying to Marco is there's a big industry out there that's really about sales, and they always have to have something short-term and relevant to discuss. As CIO of Cambridge, I had to have a lot of opinions about a lot of stuff that I frankly wasn't an expert at, but I was expected to understand. And a lot of these things, like the timing of the market, et cetera, it's extremely hard. It's hard to replicate. And it's not our core competency. It's not what we're good at, So now that we have a fund that we're running and we're taking 5-year views, hopefully 10-year views, if the companies can keep doing, like ThreadUp can do what they've been doing for the next 10 years, that'd be amazing. We don't worry about those things. You know what I mean? So like the FOMO question might matter in the next 6 months. Is it going to matter in the next 5 years? And is it going to matter for this company in the next 5 years? So we try to get a lot of that, like for me personally, just get a lot of that information out of my head and leave that to other people out there that want to talk about it. And what we just look at is, our sandbox. It's our small sandbox of companies that are tremendous companies that are from this giant, world out there that we can choose from, and try to be the best and the smartest and the most knowledgeable on those specific companies.
One more question.
Hi. What have you learned from the investments that you've made that haven't achieved the results you expected, but your investment thesis relative to those that are winners? Like, what differentiates the two, and have you learned anything that's changed your approach?
Yeah, I would say it goes back to I lose. When a business is not doing what I think it's going to do, even if it on an absolute basis still looks attractive, but it's not as good as I thought, I will start shrinking that position because it's showing that I am missing something. There's something I don't, something's off with my analysis that should lower my conviction and thus shrink the position.
Yeah, I guess so. The question is there something that you've learned about the initial investment thesis that differentiates? Because you have this approach, which makes a lot of sense, but is there something that's different between the winners and losers?
I would say, from my perspective, so I think Jordan and myself can think, creatively and have divergent views of what a business can become, right? Oftentimes, management teams will also agree with our divergent views, but the question is whether or not they can execute on it. It can either be the business itself fundamentally is too difficult. Maybe they have the wrong people in place. Maybe they make mistakes. So when I've seen us have to move on from companies like HelloFresh would be a good example. Yep. That was one that we saw its potential to become a, grocery store adjacent online marketplace of ready-to-eat food and meal kit delivery. And that's also how the company communicated themselves in many ways. But we saw over about a 18-month period that they had some operational issues that repeated, right? Mm-hmm. So you do it once, okay, you're going to learn from it, et cetera. It happened again. Doesn't make a lot of sense. And then most recently, they announced the CFO is leaving. We spoke to the company, and they gave us assurances, I would say, that they would have an answer in a short period of time, 6-8 week time frame. 3 months later, there's no answer, right? So what I'm saying is there a vision that Jordan creates for a company and we appreciate for the company. It's not that easy to achieve that always. Mm-hmm. So a lot of times it's the companies themselves failing to achieve what we think is possible and what they're trying to do.
Yeah, just being super focused on what's happening right now. If we have a view of the next 5 years, we can chart a path, and then we got to be laser focused on how they're charting that path and if it's in line with what we think. All right, one more question.
So I just have one last question. From what I've gathered from your presentation, you're primarily focusing on American or North American companies. Have you examined other areas like Europe or India or any of these other places where these opportunities exist, and if you have, what has prevented you, and if you haven't, what would get you to think about those places?
Yeah, so we do hunt in global developed markets, which is 23 countries. I'm not going to list them all, but just imagine Western Europe, Northern Europe, Australia, Japan, and obviously North America. And so since we're looking for ambitious companies run by very ambitious people, you go in a lot of other countries. There is a disproportionate amount of ambition in North America, in the United States, to be fair. And so we end up, not that we're thinking, I want to invest in the United States. That never goes through my mind of we got to own more American companies. Never think that. But the types of CEOs we're looking for just most commonly have popped up in the United States. But we're looking in other countries too. It's just, they're just harder to find. Well, I I guess I'll give some closing remarks here. Thanks so much for coming. This was a lot of fun. This is the first of many investor days, and if you are already invested in the fund, thank you. Very much appreciate your support. I have 100% of my liquid net worth in this investment strategy, so I care a lot about how it does. And if you have not invested, we'd love to have you aboard in some manner and make you a lot of money. But thanks so much for your time, and if we don't talk to you after, we'll see you next year then.